Hello and welcome to Beyond the Charts. This is a new show where we dive into fascinating charts from the world of finance and the economy, where we break down what is really going on beneath the surface. I'm your host Anurag Bansal and I hope you enjoy this. Please tell us your feedback in the comments so we can improve accordingly. Let's start with the first segment and talk about October. Look, October was a pretty rough month for Indian markets. The Nifty and the Sensex, which are India's benchmark indices, had dropped around 6%. Now, this sounds huge because we have been spoiled by straight rises in our markets ever since 2020. So even a small dip right now kind of feels like a big deal. But to put this very drop into some perspective for you, let us look at the month-wise returns for the Nifty 50. See, the 6.2% decline in October is the biggest that we have seen since March 2020. It is a very similar story for the mid and small cap indices, though small caps were down by only about 3.6%. Now, despite October's dip, the markets have still made solid gains overall. The Nifty is up by over 11% for this year, and both the mid-cap and small-cap indices have risen by more than 20% each. But as I said earlier, this is not even the worst monthly drop the Nifty has experienced. It only feels this way this time around because of how steadily our markets have climbed ever since March 2020. Now, of course, we all wish the good times would last forever, but that is rarely the case in the stock markets, right? Now look at this interesting chart that was shared by Anup from Capital Mind on Twitter. October's 6% drop is the first of its kind in over 4.5 years or 54 months or so. And that is why this dip feels more intense than it actually is. Now, of course, the headline indices don't quite give us a full picture of what is happening under the surface. So let's go beyond the headlines and understand the broader market performance. First up, let's look at sectoral indices. This tells us a bit of a concerning story. Every sector closed October in the red. Particularly steep losses in key industries were observed like auto, oil, gas, and consumer durables. Each of these fell by more than 10% during the month. The market's weakness is also pretty reflective in stocks reaching new peaks. In the month of October, only about 242 stocks hit their 52 weeks high, and this was significantly down from a usual monthly average of around 310 stocks. Now moving ahead, the advanced decline ratio is another figure that gives us an important market signal, and it compares rising stocks to falling ones. A ratio above 1 shows that more stocks are gaining ground, while a ratio below 1 indicates that more ones are declining. Now October's ratio was 1.18, and this says that despite the overall market weakness, so to speak, more individual stocks actually managed to move higher than lower during the month. Let's now move further ahead and analyze two key technical indicators, the 100-day and the 200-day moving averages. Now, these indicators give us a very quick view of the trend of the overall market. You can think of the 100-day moving average as a quick snapshot of the medium-term price momentum, while the 200-day moving average talks about more of a longer-term trend. Now, generally, when stocks trade above these averages, it is considered a positive sign or a bullish movement. Trading below it signals potential weakness or a bearish trend. Now, looking at the Nifty 50, the month of October saw a notable decline in the number of stocks that were trading above both their 100-day and their 200-day moving averages, which is a very clear sign of weakening market momentum and breadth as well. But when we zoom out and look at the market through the broader Nifty 500 lens, the picture becomes even more concerning. Only about 280 stocks are currently trading above their 200-day moving average, which is a very big drop from recent months where roughly 400 stocks were maintaining a positive trend here. And if you look at the medium-term trend, things look even more concerning. The number of Nifty 500 stocks that were trading above their 100-day moving average has dropped to around 170 stocks, and this is sharply down from the usual average of about 300. So while the headline index numbers might not seem too alarming right now, they are probably masking a lot of weakness beneath the surface. Individual stocks are clearly struggling right now, and much more so than the broader market indices are suggesting. Most of the damage is in mid, small and micro cap stocks, which have risen very sharply this year. But now the obvious question that might come to your mind is, why did the market exactly fall? See, several key factors come into play over here. The first factor I want to talk to you about here is the foreign institutional investors shift. See, FIIs or foreign institutional investors have shifted their focus back to China right now, and this has triggered record outflows from the Indian markets. The month of October saw FIIs pull out over 1 lakh crore rupees, which is the largest monthly withdrawal that India has ever experienced. The second point here is that the latest corporate earnings show a very concerning picture, so to speak. As major companies release their September quarter's results, they seem to be falling short of expectations, especially given their lofty stock valuations right now. The pattern is pretty concerning if you think about it. Companies now have posted weak, single-digit earnings growth for 6 consecutive quarters. What is even more concerning beyond that is that the earnings fell by 3.4% this quarter, which is a significant reversal, so to speak, from the growth that we saw in September 2023. Now moving on, let's also look at the sectoral performance. And the reason this is important is because taking a look at performance on a sectoral level gives us a little more insight into which sectors exactly are feeling the pain. Now, the commodity sector has been the biggest disappointment here, and that has shown weak performance for nearly 2 years straight. Several other sectors have also been underperforming. For example, energy has barely grown with just a tiny 0.1% increase in the month of September, and it has continued its poor showing over the last 2 years or so now. The IT sector is not doing much better either, and the growth has stuck below 10%, and this is the 5th quarter in a row of sluggish performance here. Moving on, let's talk about the financial services sector. Now, this has also slowed down in the recent months, but it is still maintaining healthy growth above 17%. But that said, there are some bright spots here. Consumer discretionary businesses, including the likes of cars, media, entertainment, and real estate, bounced back with a solid 12.7% growth after a year of weak results. The telecommunication sector is another success story here. This has grown by about 15% as compared to last year. This turnaround comes after several slow quarters, largely thanks to the price increases by major telecom companies, Jio and Airtel. To give you some context, Jio, Airtel and Vodafone Idea, all of them raised their plan prices between 10 to 27% in the month of July. Now, talking about the profits at the sectoral level, despite a 2.4% drop in revenues in the commodity sector, profits have grown by an impressive 53.5% year on year as compared to last year, when the growth was down by over 18%. The telecom sector has also reported another strong quarter of profit growth. After about 63% growth in the June quarter, this sector has seen about 89% year-over-year growth in the month of September. Apart from commodities and telecom, only IT sectors reported growth in profits this time. All other sectors have struggled. The energy sector, for instance, has been the biggest underperformer, and it has seen growth drop by over 46%. Other sectors where profit growth has moderated a little bit include the likes of FMCG, financial services, healthcare, industrials, and the services sector. Now, this combination of factors has understandably made investors pretty nervous. With Indian stocks trading at a bit of premium valuations, the real question then becomes, can these high prices really be justified when earnings growth are stalling? This mismatch between valuations and performance says that we might be headed for a market correction, so to speak. In a recent report, Motilal Oswal pointed out that Nifty large, mid and small caps are all trading above their valuations. Now do keep in mind that valuations are not the best tool to time the markets for sure. What valuations only tell you is that if the starting valuations are high, future returns tend to be low and vice versa. But that said, we've historically seen markets go a long time being overvalued. Now that brings us to the end of the first segment. Let's now move on to the second segment and look at bank credit growth. See, every month the RBI releases data on the sectoral deployment of credit. This tells us where banks exactly are lending their money, whether it is to farmers, industries, services, businesses, or individual borrowers for that matter. Now, this data gives us a great peek into which sectors of the economy are exactly attracting bank financing, and by extension of it, where economic activity might be picking up or for that matter slowing down. Now, the latest numbers for September are pretty interesting. Overall bank lending has grown by about 14% as compared to last year. But that's actually a slowdown from 15.3% of a growth that we saw in the month of September 2023. Now, this slight deceleration in credit growth might be our first clue that there is something happening with the economy. There's also the fact that the RBI has constantly been warning us about the big gap between credit growth and deposit growth that we've covered multiple times on the Daily Brief as well. Now, since COVID, credit growth, or the rate at which banks are lending, has grown much faster than deposit growth has, and the RBI has been worried about potential liquidity issues here. Now, of course, this is a bit of a complicated issue, and like I mentioned, we've spoken about this in the Daily Brief, so do check it out if you're interested. Moving on, agricultural credit growth has been reasonably healthy here. Though it has moderated from its peak that was seen in March, it still continues to grow at a pretty healthy rate of about 16.4%. Now, this is probably an indication that farming activity might be pretty strong given that monsoons have been really good this year. Moving on, industrial lending is also showing some strong momentum, with credit growth jumping to 9.1% compared to last year, which is a significant improvement from the 6% growth that was recorded in September 2023. Now, this pretty much aligns with what RBI has said in the last couple of bulletins, that there has been a substantial increase in investment intentions by companies across critical sections. Capacity utilization has also increased pretty steadily, which is a great sign of demand. But one worrying factor here that is to keep an eye on for us is slowing urban demand. Look, while rural demand seems to be picking up pretty steadily, it remains to be seen if the loss in urban demand can be offset by rural demand in the country. When you look at how banks are lending to companies by their size, credit to micro and small businesses have remained the same in the month of September, but credit to large companies have decreased quite a bit. When you zoom out a little, credit to small and medium enterprises have been doing pretty well and are growing at double-digit rates of growth. But credit to large companies have been pretty weak with consistently single-digit growth over the last year or so. Also, we thought it would be pretty interesting to look at these things sector by sector. We look at chemical and chemical products, food processing, petroleum, coal products and nuclear fuels, and engineering industries as well. Now, all of these sectors saw faster credit growth as compared to last year. But that said, credit to sectors like metal and textiles slowed down in this period. Talking about the services sector, that shows a pretty interesting mix of trends. Overall, credit growth has cooled to about 15.2% as compared to last year's massive 21.6%. But commercial real estate over here stands out as a bright spot as it maintains an impressive growth of about 20% for 8 straight months and has reached 25.5% as a growth number in the month of September. Now, this pretty much aligns with what we had spoken about in residential real estate doing well recently on the Daily Brief show. Now let's move on and look at consumer loans where a pretty interesting story comes out. See, overall, personal loan growth fell month on month to about 16.4%. Personal loan growth has steadily fallen from the highs of over 20% last year. This is due to RBI warning banks to cut down on reckless personal loans, so to speak. Now, as they were concerned about the rise in unsecured lending, the RBI also took action in November 2023 by increasing risk weights for unsecured loans. Banks now face a 150% risk weight, which is up by 25 percentage points, and NBFCs must maintain a 125% risk weight, which is also up by 25 percentage points. Now, this technical change has real-world effects. Banks now have to set aside more capital for these loans, so it leads to higher interest rates for borrowers. And this policy appears to be working as it was intended. It has made unsecured loans less attractive and have encouraged more prudent borrowing behavior. Then there's also the fact that there has been a rise in non-performing assets or NPAs in some segments of retail lending. Banks and NBFCs have consistently reported steady increasing NPAs in retail loans and microfinance. Housing loan growth has also continued to remain high, which matched the increased lending by banks to real estate companies. Now, credit card lending, which in the month of October 2023 was growing at a crazy 44% year over year, has now fallen to about 18%. Now, this is due to the RBI warning banks, like I mentioned earlier. There's also the fact that there has been an increase in defaults on credit cards and several banks have reduced limits on many consumer segments. At the same time as this, the costs of funds have gone up significantly. This can be seen in the results of SBI Cards, which is India's largest card issuing network. SBI Card has seen a series of bad quarters since last year, with NPAs, cost of funds rising, and revenues and profits falling. Gold loans have also seen a remarkable surge, and they have jumped up to 51% growth as compared to just 14.6% last year. Now, this boom makes a lot of sense given rising gold prices, which allow borrowers to secure larger loans against their gold assets. Now with that, let's move on to the third and the final segment of this episode, which is the shifting dynamics between public and private markets. Let's start by exploring a very intriguing trend that was highlighted in Apollo Global Management's recent report. This talks about the changing landscape between public and private markets in US and Europe. Now over here, we're currently witnessing a very significant shift in how large companies are choosing to fund themselves. More major businesses are now opting to stay private rather than listing on public exchanges. Now this trend is particularly visible in the US, where the number of publicly listed companies has dropped dramatically from about 8,000 in the mid-1990s to roughly just 4,000 today. This decline in public listings represents a fundamental change in how business access capital and also structure their operations. What's particularly interesting here is the scale of companies that are choosing to stay private. These are not just small businesses that are avoiding public markets. 65% of the companies that are private have revenues between $100 million and $500 million. And likewise, about 10% of the companies have revenues between $500 million and $1 billion. And that's not even all. About 11% of the companies have revenues greater than $1 billion, which is a massive number. So therefore, the growing influence of private equity in the US markets is pretty hard to ignore. Their share of investments as a percentage of the total equity markets in the US have jumped from just about 3.8% in 2003 to more than 10% in 2023. Now, for those of you who are unfamiliar with private equity firms, they are investors who buy stakes in mature companies which are not quite listed on the stock exchanges. Instead of trading public stocks like regular investors, these firms either invest directly in private businesses or they buy public companies and then take them private. Their strategy is pretty straightforward if you think about it. Improve these companies' performances and then later sell them for a profit. Now, if you look at the European markets, particularly the UK and Germany, there has been a dramatic decline in publicly listed companies. Let's look at the numbers to get a sense of the story. These markets have seen their listed companies drop from around 3,300 to just 1,900. Now, this massive decrease shows just how European markets are shifting away from traditional public listings. In Europe, 96% of companies earning over 100 million US dollars in revenue are choosing to stay private now. Now, I'm sure if you're still watching or listening, there's one question that you might be thinking about. Why exactly are more companies choosing to remain private? Now, there are several reasons why companies are choosing this. First, thanks to the boom in venture capital, which is VC, and private equity, which is PE, these companies can now very easily raise money without quite going public. They no longer need to list on the stock exchanges to just get funding. The second reason is that staying private gives these companies a little more freedom to run their businesses as in how they want. They can avoid all the regulations and detailed financial reporting that public companies must deal with. And of course, the third and the most important reason is that private companies do not quite face constant pressure from shareholders who demand quick profits every quarter. And this freedom, of course, allows them to focus on what really matters, which is building sustainable long-term growth companies rather than chasing short-term gains in order to keep stock prices afloat. So that's all from me today. I hope you enjoyed this new show. Thank you so much for watching. If you have any feedback on how we can improve and what we can do better, please do let us know in the comment section. And even if you like this show, please do share your support in the comments and we'd love to reply to you and have a chat with you. Thank you and I'll see you in the next one. Take care and goodbye.